Well, I've been very pleased with the performance we've seen so far in the Granite portfolios. It's great to always have positive performance year over year, but in a period like this, it really is about actually trying to minimize the negative returns you see in the portfolios. And I think we've done a good job of that. One reason that we've done so well is that we've had some hedges in our portfolios in the US and international markets, which have helped protect us during those market downturns. Given we have a tactical approach to our strategy, we're always looking at what's going on in the market conditions out there and adjusting our portfolios. So during the quarter, we took some money off the table on Canadian equities and international equities and actually moved that to the United States. That might seem like a bit of a strange trade given all the stuff going on with Trump and trade. However, we feel that the US will benefit the most as a result of the fact that they are actually dictating the terms right now on the trade discussions. The second part of that is that when you do have uncertainty in the markets, people just tend to go to the United States as a flight to safety. So I think having the overweight the United States, it's likely will benefit us over the next 3 to 6 months. We're also overweight the US dollar, given the fact that we have seen some strength in that over the last few months. But we have taken a little bit off the table recently as we started to see those trade discussions flare up a bit more. And then finally, we've had hedges in place when it comes to the US equity market and international equity markets to help protect us for the heightened volatility that we've seen and the downturn we've seen in the last 2 or 3 weeks. I feel this is a question I'm going to get asked quite often over the next few years. Now, fortunately for us, we have a very strong bond portfolio that is really well diversified across different geographies and across managers. And that's very important because our managers have different expertise in different segments of the bond market. And given that the bond environment today is going to be a lot different than what we've seen in the last few years, this is going to let us hold up really well given the different conditions out there. When you look through different economies around the world, not all of them are going to be raising interest rates at the same time or at the same pace. So it's going to be important to have that diversification across different geographies. Our portfolios today have a lower duration than the market, but also have a higher yield. And I think when you put that together, that will help us hold up really well given the rising interest rate environment that we see today.